Okay, well, my name is Brian Kaplan. I'm editor of the Banker magazine. I'd like to welcome everybody today to this roundtable that we're having in the Bracken Room in the Financial Times head office in London. And the roundtable this morning is called The New Banking Landscape. Traditionally at the Banker, we've tended every year to have a roundtable where we've invited in the heads of the financial institutions groups in the international banks to talk about how they see the banking market in terms of capital raising and balance sheet restructuring and consolidation. Obviously, it's of great interest to the bankers' readers, who are mainly chief executives of commercial and universal banks all around the world. And we thought it was particularly appropriate this year to be having the roundtable. Obviously, so much has changed in the banking market. There's many issues to discuss. And broadly, we're going to cover those three key topics: the capital raising, the balance sheet restructuring and management, and how we see things coming out of the crisis in terms of consolidation. So I'd like to start off by asking everybody to introduce themselves, and then we'll get into the topics. So if I could start on my left, please.
Sean Park from Morgan Stanley in London, where I head our financial institutions team within capital markets.
Hello, I'm Ian Gladman. I'm co-head of the financial institutions team at UBS on the investment banking side.
I am Ambroise Laurent. I am the global head of the Financial Institutions Group at BNP Paribas.
Hello, I'm Rolf Peterman, and I run the Financial Institutions Group at Dresdner Kleinwood in investment banking.
David Marks, I'm chairman of FIG Capital Markets at JP Morgan in Europe.
Philip Alexander, I'm the finance editor of the Banker magazine.
Okay, well, Ambrose, you were saying before we started that you stating the obvious in some ways, that it was a momentous time in banking in terms of the changes we were going through. I mean, would you be able to give us sort of a very broad view of where you think we're going to go from here in terms of how banking business is going to be done?
Well, it's very difficult to say. First of all, I think we should emphasize the fact that there is no longer a financial landscape, but a financial ruins. The industry is in a very difficult situation, and on top of that, a certain number of very significant institutions are struggling to have a future. So maybe before looking far ahead, maybe we've got to pause and just to ask ourselves, who are going to survive? What are the institutions which are going to survive? And why is it that we are in such a difficult situation?
David Marks, do you want to comment on that? I mean, do you see that... some people have talked about sort of going a reversion to kind of narrow banking amongst the world banks. Is that an idea you think that's going to take off?
Well, I guess it depends a little bit by what you mean in terms of narrow banking. Because I think there's very little doubt that we may see a return to a banking landscape, a ruined landscape maybe, which is more akin to what we saw in the 70s and 80s in terms of effective regulation or effective supervision, meaning that the earnings capability, the leverage that the banking industry has enjoyed over the last decade, and indeed the withdrawal from the shadow banking activities will mean that focus will be very much on core banking products, and with a much greater focus on leverage ratios and loan-to-deposit ratios. There clearly has also been some interesting discussion, particularly for an American institution, as to the value of going back to some form of Glass-Steagall and the separation of commercial and investment banking. Frankly, it's very, very hard to see how in practice that would work unless that was a regulation that was imposed globally, which would be a regrettable step. I think there's also been some interesting discussion about, can single economies afford to have global banks? The risks for certain jurisdictions in having banking systems where a significant proportion of their assets are outside of the domestic country has been pretty dramatically highlighted to us in the course of the last 12 months.
Rolf Peterman from Dresdner, are you as gloomy as that?
I think what we'll see, and I actually do agree, along the capital and funding spectrum, we see a focus on simplicity, i.e. common equity, and it only can come from government and existing shareholders, and plain vanilla senior funding, be it government-backed, and there's a ray of hope, the fact that we've seen some good issuance, first good issuance in non-government-backed senior, 5 years, even 10 years. These are first ray of hopes. The capital structure in between, all forms of hybrid, even upper tier 2, lower tier 2.
Right.
I think because of some of the complexities of the products and the unclarity around it, e.g. loss absorption, some of those hybrid step-up deals which were callable, not having been called, has created a major uncertainty and dislocation in the investor community. So I fear for that reason alone, we will still see an extended period where we have this sort of simplistic plain vanilla equity, plain vanilla senior debt raising. However, again, for some ray of hope, once we see some market stability, then banks in particular will have the ability to start changing their whole capital structure and funding mix, because we are seeing some major changes in the capital structure. And somebody mentioned the massive increase in Tier 1 ratios which regulators impose, and the focus on leverage, i.e. deleveraging. That is now more micro picture, but in terms of business potential for our industry, and also things our clients, our banking clients globally need to do, once we have this stability, then you can see a lot of reallocation of capital tranches from certain buckets into other buckets.
Because you mentioned some deals getting done there, non-government deals. So what kinds of banks are still able to access the markets?
Well, in reality, you can distinguish two. You have those where you need to say essentially they have an implicit government guarantee. So, and our House Commerce is a case in point. Clearly, we have benefited from the 25% plus one stake to issue the non-guaranteed deal. And then you can see some of the traditional blue chip names. I mean, Goldman has issued a 10-year without a government guarantee, where you still have the credibility and the blue chip value. And by the way, I think that's one of the biggest issues we have and will continue to have for a long time, is the famous Keynesian animal spirits.